All right, my lovely friends, here we go. Back again, me, for my post-market wrap-up on this lovely day. But this loveliness may stop kind of soon, and I want to talk about that. It's important. Wednesday, September 19th, 2018. Let's start off with some of the basics here. The market finished mixed today. The Dow Jones Industrial Average put on a decent gain, about 150 points or so, or 0.6%. S&P 500 put on about 0.2%. NASDAQ actually finished in the negative. However, if you were to turn on the Confederacy of Dunces right now, they're going to try to overhype this. The market didn't do anything. The real action continues to be the bond market. Admittedly, I got this wrong so far. Over the weekend on Sunday, I explained to you there were a few very important things that we needed to follow. One was this tariff, the introduction of another $200 billion in tariffs for China. I explained to all of you that it was priced into the market. You witnessed what happened. Stocks went higher when it was actually announced. No surprise to any of you out here. I have also called this week 100% perfectly with regard to where the stock market is going, but I missed big time this sell-off here in the bond market. That's where we need to be looking here. As the market just closed, 10-year yield 3.078. If this continues and the dollar stays where it is or does not weaken, this is not good news for the stock market, even though everyone's in the euphoric stage right now. It's good for bank stocks. As you can see, banks took off today. But for the overall market, not so much. And I don't think it's getting much attention. However, I posted at least 3 articles today, at least 3. More warnings from banks, from hedge funds, governments around the world warning about the environment we're in. And I've never seen this before, where so many warnings in just a short period of time have been published. This did not happen prior to the last market meltdown. So, look, we all understand this is going to correct to fair value or reset or do it however you want to put it. But I really think there's something else going on here. Either one, sit down for this one. This is a bullish sign. When people start to get real negative about the market tends to go higher, and vice versa. Or something real is brewing here, and these banks, these hedge funds are trying to cover their rear ends, if you get my drift. So when this whole thing melts down, maybe we're close. I don't speculate anymore. I don't care. I really don't. I trade the market I have, not the market I'm dreaming about, thinking about, foaming at the mouth over, whatever. Doesn't matter. We're in the here and now. That's the market I am trading. So again, for all of you, and I keep getting this every single day of my life, email after email, Greg, when's this going to end? I have no idea. Don't know, don't care. It's really in la la land, like, this is incredible. Really, Disney should make a movie about this. They probably will at one point, like I said yesterday. Anyway, so these warnings, I don't know what to make of it. Again, could be a bullish sign for the market, or it could mean that we are literally getting close to that moment of maximum saturation where we cannot take on any more debt, when we literally max out the credit card. These world central banks are very crafty what they're doing in front of our faces, under the table, rigging everything. So we don't know. This is a managed market. We've never been here before. So we will need to pay attention to that. But the big tell for this guy, now understand, and I want to cover this real quick. I have never drawn a line in the sand with regard to the 10-year yield. I explained to you that the sweet spot appears to be below 3% as long as the dollar stays weak. Going above 3% doesn't necessarily mean that this whole thing is going to come down. And I always jerk around online and I find message boards and I see my name mentioned here and there. Oh, the Greg Mannarino put a line in the sand and we crossed it. I never did that. Show me anywhere where I have said there's a line in the sand with the 10-year yield. Sorry, you're not going to find it. So we need to keep our eye on it. We need to watch the dollar. And I'm not going to talk about it anymore because I've done it a million times. The compensatory mechanism that exists between the dollar and the 10-year yield. Anyway, so that's where we are. And this has the potential to turn ugly really quick. If we witness the 10-year yield continue to climb, they tried to prop this up today. I don't know how many of you caught it. I think I actually took a snapshot and posted it. It didn't work. And we see the dollar strengthen. I mean, these are two big negatives for the stock market that's in some kind of a euphoric stage right now. It's going to be interesting to see how the rest of this week plays out and into next week. But anyway, that's where we are right now. As always, it's really about the 10-year yield. So keep your eye on it. Watch it. Watch the chart. It's right on my website for you. Just see what it's doing. Watch the stock market. Watch the dollar chart right underneath the bond market chart. It's very simple. It's not hard. And also the gauge, dead center on my page, first page of my website, on the bottom, traderstrace.net. It's never been wrong. Never been wrong since I put it up there. So take advantage of this. I am 100% net long this market right now. I have 1, 2, 3, 4, 5, 6, 7, 8 credit spreads open right now, all on the long end. Apple, Citigroup, CVS, Disney, Goldman Sachs, Morgan Stanley, Microsoft, and JP Morgan. 6 of these expire Friday. And they're all doing very well, and I would imagine they're going to continue to do so. Learn credit spreads if you don't know that, traders out here. Anyway, that's where we are at. We will resume the loveliness tomorrow morning. See you then.